Welcome to Taxbytes for Expats, the top tax tips you want to know as an expat. The podcast is here to help answer the common queries and concerns expats have when moving to or from Ireland. Complex taxes explained simply. We'll focus on the Irish and international tax issues to be aware of to ensure you save time, money, and stress.
Avoid the hassle of dealing with your bank and transfer online, by app or over the phone or Currencies Direct today. Keep listening for an exclusive offer for Taxbytes for Expats listeners, and thanks to Currencies Direct for their support of this podcast. Obviously, I'm not an actuary, so I don't understand the statistics, but I always thought the de-risking and approach to retirement was to ensure that you didn't have sudden drops in the value of the assets. So therefore, you could have some assurance that what you'd contributed over the lifetime, where you've had peaks and troughs within the market, doesn't bite you at the end of the phase. Explain to me why you don't agree with that, because to me, that was kind of an accepted approach, but you're the expert.
It's conventional wisdom, but it's not wise. It doesn't work. So a sudden drop. So this year was maybe a great example. Okay. We had Liberation Day in Q1, well, April this year, right?
Mm-hmm.
What happened there, okay, was that middle of the road fund that has underperformed by a significant magnitude over the last 10 years. It fell 10% in that month. Okay.
Right.
So if you had $1 million in that middle of the road fund, which, per lifestyling, okay, according to your lifestyling, we've de-risked you, you're in the middle of the road fund now, that dropped 10% in that particular month. A more aggressive, say 90-10 portfolio, right? A more growth oriented portfolio, which I believe for most of us has been the better option, particularly for long-term investors and ARF investors. That fell approximately 20% in that particular month. So the middle of the road fell by 10. The higher volatility, higher returns fund fell temporarily by 20%, right? So it was more volatile, absolutely. And that's part of the deal. Volatility is the price you pay for your long-term benefit. Things have never stayed down. Things have never stayed down. Yes, they've stayed down for 5, even 10 years, right? But they have never stayed down for the long term. In the past 12 months, including that decline, our middle of the road fund has delivered 6% positive returns, which is great. You take 6%, but your more volatile fund has delivered 11% in the last 12 months. So that summarizes the long-term logic for people that are able and willing and know what they're doing and can handle the volatility to invest in more growth-oriented funds. The logic, as you rightly point out, is that, well, yeah, that's fine, Paddy, but what if, the fall and the market fall coincides with the point at which you are taking your money out?
Yeah.
Well, I would argue, if you have done a plan and you thought about this, you've done a pre-mortem, as I like to say, what could go wrong here and how do I protect against it in the future? If you have done that pre-mortem, you will have other assets that you can turn to if you need cash at that particular point. If an investor in a 90-10 portfolio needed access to cash in April when their fund was down 20%, did they have 10% in the portfolio that was, say, for argument's sake, in money markets or bonds, which did not fall in April, that you could draw on? Or did you have other assets outside that portfolio that you could draw on if you happen to have to access a lump sum in April of this particular year without being able to wait a few months? That's the logic. Having a plan and having thought about these things in advance is how people can ensure that they are achieving the returns that they deserve over the longer term. And that's where I go back to the planning piece. If you go into somebody who is purely transactional and just wants to sell your product, the chances are most of them won't do that other thinking, that big picture thinking. And let's look at your other assets. And okay, if this happens at this point in time, how will we manage and navigate that? And where will the other assets and incomes come from? They'll just sell you a product most likely the middle of the road kind of fund where, look at, as you said, if you achieve 5.5% per year over 10 years, you might be happy, but you mightn't be happy if you've realized that you've left 4% a year on the table unnecessarily, potentially.
100%. And what strikes me when you explain that is if you go into one of those situations, you're buying an outcome, you're not buying a bespoke plan. And the reality is, with something that you worked hard for, you want it to be bespoke, because what you just described there is different for everyone. Like people will have different assets, different pre-mortem plans, as you call it. So to kind of zoom out a little bit, when people are listening to this, and bear in mind that a lot of the listeners are kind of foraying into the market here for the first time, and obviously there's nuances there around who can be helped and who can't. But when they're having a conversation with somebody who is genuinely independent, how do they know? Or how do they know if someone's just selling a product? What are the distinguishing factors of that conversation?
Ultimately, if you, and again, just to go back to that kind of those different layers, if you go into a bank, you'll know that, yes, there's probably a decent level of qualification from the advisor and reasonable level of intent, generally speaking. But ultimately, it's all about you buying a product. Okay. So that's the end of the story. Okay. You'll get advice, but they'll want you to buy a product because that's how they get paid.
Okay. Yeah.
If you go to a broker and they are giving you a free plan and there's a product put in front of you, again, it's all about the product. That's how they're being paid. If they're not charging you, and they say, don't worry about it, the insurance company will pay me when we set up this pension or we set up this investment, then it is all about the product. It's the commission that is generating their income. And it's absolutely reasonable for you to ask, what is in this for you? How are you paid and how much are you paid? That they are obliged to disclose that when you purchase, okay? But ask them before you sign up to anything. What are you being paid on this product? It's a fair ask because whatever they're being paid by the insurance company, you are paying for in fees on an annual basis in the background that you do not see. And that is one of the issues I have and concerns I have over that particular model. The investor and client does not see that what's going on.
I'll give you an example of something that really resonated with us as a team recently, that we had a client who had brought a basket of investments from the UK to Ireland, and with it some massive tax complexity, an expensive tax return because the analysis was fraught with difficulty. The data set was really difficult to understand. But in our analysis of it, we were having a conversation about what the cost basis for the investment was with FX movements, etc., etc. And we realised that lurking in the middle of it was about £6,000 worth of fees that probably the client had never seen, and from a tax perspective are a bit benign. So your point is right. You know, that transparency, those direct questions. And what's very interesting, as you were telling me that story, it made me think, if you walk into the Honda dealership, you don't expect them to tell you that you actually really need a Land Rover, because that dealership's across the road. And that's what you're actually describing. And that's not to say that if you need a Honda, you shouldn't go to the Honda dealer. He serves a purpose. But, don't expect something from somebody when you're given the word free. It's actually misleading. There is no such thing. There's no such thing as anything free in this life, in the majority of cases. Like, we all know that. But yet sometimes when we walk in and we sit across a desk and someone makes us a coffee and they're wearing a suit and they understand and they smile, we tend to forget that. I mean, we all do. I've done it as well. We all have in different scenarios. It's really important to be aware of that with something like your financial planning in your future, I would imagine.
Yeah, look, and again, it's about getting value, right? You're not you're not looking for uncomfortable conversations or to make things awkward. You're just looking for information, right? So, I have seen cases where I've recommended to people, they might ask me, oh, come here, look, it's such and such is recommended that I do A, B, and C. And I give them a few pointers and I'd say, okay, ask them a couple of questions. Say, what providers do they use? What insurance company do they use? And if you do, an investment for 300,000 and you start a pension for 500 a month, what do they get paid from the insurance company, right? And if you're dealing with a firm, and whether they're a broker or financial planning firm, that is recommending this, and you ask those questions, if they don't come back or if they kick up about giving that information, then maybe that's a signal that you maybe should shop around a little bit further until you find somebody who is open to those conversations. They're reasonable questions to ask. And again, this is all on the basis of getting value for money, because whatever they are getting paid in commission, you are paying for on an annual basis via scheme fees.
So to find value for money for me there, what does that mean?
Again, it depends on what you are looking for from the firm. If you go to a bank and you buy a product, the reality is the level of service might be fairly minimal. Okay. You may get a phone call each year asking you in for an annual review, which is most often really just an exercise to see if you need to buy anything more, okay, or anything new a year later or 2 years later. So the service, the ongoing advice mightn't be massive. You'll get an annual statement. You go to a broker or a financial planning firm, it will vary. Some brokers will sell you the product and you will never hear from them again. Others, whether they're brokers or financial planning firms, they may have a very proactive service offering for you, whereby if they've done a cash flow analysis and a cash flow plan, that they would update that each year with you. They'd invite you to meet each year, invite you to client events. The spectrum of service offering out there is huge. It genuinely is. We have people come to us who have usually accumulated significant levels of assets, as I said, are towards the end of their careers or already retired. And the variance in service level, never mind performance, etc., the variance in service level and fees that we see people get is massive. An awful lot of people would have 7 figures invested with some companies and they wouldn't even get as much as a phone call each year, whereas others get, multiple invites for meetings, et cetera, and lots of information and advice. So it's about understanding and being clear about what you want from it.
Yeah.
And again, without trying to sound too philosophical, do you actually want to work with somebody where you have engaged conversations and you can pick up the phone and you can talk to them about house purchases or gifts to the kids, or Jesus, should we buy this or that, or what do you reckon about this? Do you want those kind of conversations with somebody, or do you just want it to be transactional? I want to invest in, the global index, and I don't want to think about it. I don't want to talk to anyone about it. I don't need any service. And then you should be paying accordingly. And that's the reality, right? If you want a transactional piece, then you need to be paying 1% or less. If you want something a bit more, then you're going to be paying 1% or slightly more, but certainly not 3% per year fees, which we see some firms charging people and not delivering on service or performance.
And now a quick word on our episode sponsor, Currencies Direct. If you're looking for a fast, easy way to transfer money to or from Ireland without the hassle and cost of dealing with your bank, keep it simple with Currencies Direct. Whether you're buying property or require regular currency transfers, Currencies Direct can help you save money. As a special offer for our listeners, when you use the link in the show notes and quote Expat taxes when registering with Currencies Direct, you'll receive a €50 one-for-all or Amazon voucher when you transfer €5,000 or more in your first 6 months with Currencies Direct. Registration is quick and easy, and you decide how you transfer 24/7 via their online money transfer service, over the phone with one of their friendly experts, or by using their handy mobile app. Check the show notes or head to currenciesdirect.com to register, and thanks to Currencies Direct for the support of this podcast. That's a very good point. So what are you paying and what are you getting? Be clear about those two things. And the answer for both of those, maybe you're not getting a lot and you're not paying much, but if you're paying a lot and not getting much, then you've got to...
That's exactly the point, Steph, right? It's the same as anything, right? You don't want to be paying for stuff you're not getting, or don't want.
And you see, the thing is as well, you've got a cohort of people, particularly now, who are very financially literate. Or perhaps you're married to one of them, like I am. My husband is eagle-eyed with this stuff. Frankly, to be honest, something comes in the door. I'm an accountant, I'm a tax advisor, but you get lots of mail, you've got to decide what you focus on. And I think the observation I would have is it's easy when you see lots of financial information to miss the salient points. In other words, what am I paying? What does this cost me? Where is my fee disclosed? Is the industry doing enough to make sure that people can clearly see what it's costing them if they haven't asked that question at the start?
It's really difficult. It is really difficult. So people that are all over this will have heard of KID documents, key investor documents. So if you do a lump sum investment, non-pension investment, the provider, the insurance company or the provider is obliged to give you and send you a KID document. And the KID document for that particular fund and that particular approach through that intermediary will outline the precise fees, the total fees that you will pay each year in the background. And that includes annual management charge, insurance company fund charges, other transaction costs, commissions to the intermediary. Typically speaking, you will see that total in and around 2%. And that's a broad brush, but in and around 2% per year, total fees. Okay.
Mhm.
Whereas the annual management charge, or the AMC as it's often quoted to people, will typically say, again, typically will say 1% per year. But the actual total effective rate of charge is 2%. And again, that's broad strokes, but that's typically what we see. So with
Right.
a
Yeah.
non-pension product, you will get that clarity, or you should be getting that clarity when and just as you start the product. With a pension, there is no obligation on a provider to provide a KID document. Explain that. So, are they doing as much as they can? I certainly don't think so. And it's the reason why we do not use insurance companies if and when new clients want us to manage and have assets under our counsel. We use a platform where everything is secure in the client's names. There's total transparency. You can see every transaction on an account, fees, charges, ins, outs. Everything is totally transparent and visible to the client, and that's why we love it.
Look, the reality is if certain types of behavior are rewarded and incentivized, they generally tend to be pervasive. And I suppose as the industry moves forward, like we've seen this in other sectors, you incentivize people to put solar panels on their house, and they do because it makes sense. You tell them to drive an electric car, or you give them 15 cents when they return a bottle. When things hit people's pockets, they tend to take action. And the reality is that in this space, which is complex and sometimes overwhelming, your podcast speaks to the very heart of it. Make an informed decision, because no one's knocking at your door to break this down for you. You kind of need to ensure you understand where you're going and who you're asking.
And look, I think at the end of the day, my view is that commissions are not a bad thing, right? They're
No.
not evil or the devil. They ensure that advice is available to all. If commissions were banned like they were in the UK under RDR a number of years ago, then all of a sudden bank assurance disappeared in the UK, I believe, overnight when commissions were banned, because it was like, well, people aren't going to pay two
Yeah.
grand of an invoice for financial advice. They're getting the advice because there is commissions in the background. So there is absolutely nothing evil about commissions, but it's to understand what fees you are paying as a result of those commissions.
And I think as well, the commission model, there's like you said at the very start, there's pros and cons for all of this. You
Mm,
hit exactly, on to the heart of it there. We will often find that there's a cohort of client that actually could really benefit from some really good tax advice, but sometimes it's beyond their means for whatever reason. The commission model cuts through that, because what it does is it allows both parties, where transparency is there, to share in the success of the relationship. That's what the aim of commission is. It's when you diverge from that and you end up in murky waters and there isn't a mutually beneficial relationship, that I personally find it feels unfair. And I think you probably would agree with
yeah,
me.
totally. And look, I think there's a movement in the marketplace at the moment as well of consolidation, right?
There's a lot of it happening.
There's financial planning firms and brokerage firms being bought up rather, by some large consolidators. And again, there's nothing necessarily wrong with that, but it's for the end client who will receive that letter to say, hey, such and such is, we've merged or we're going into partnership with X, Y, or Z. Everything is fine, and hopefully it will, and hopefully service will improve, and your benefits will increase. But it's to be mindful that nothing is going to change for you in terms of increases in fees or reductions in service. That's just something to keep an eye on for people, because a lot of that happening at the moment.
Paddy, if people want to talk to you, how do they reach you? We'll put the information in the show notes, but it's great for you to give out a call to action here.
Okay, to me, I think where I like to advise people to check out is the blog or the podcast on informeddecisions.ie. We certainly don't pretend to know it all, but we've been doing this and sharing information for 10 years, and we never seem to run out of topics. We have 345 podcasts I just checked there this morning done, and similar number of blogs. And look, have a read and a listen, and if you like what you hear and you think you might benefit from what we do, be delighted to have a chat. But one other thing I just wanted to mention, if I can, Steph, is around, and again, it's something that I was looking at yesterday for a client: active versus passive investing.
Yeah, a lot of this now, isn't there?
It's well covered, and I won't hammer it, but what I would love people to check out is the SPIVA report, SPIVA. If you are using a discretionary fund manager, or you're actively managed funds, or you're actively managing your own share portfolio, I encourage you to check the SPIVA report, where 92% of actively managed funds in Europe, 92% have underperformed the index. In the US, the figure is 88% of actively have underperformed the index. It's an interesting one. By all means, discretionary managed can be good from a tax planning perspective, but maybe not from a performance perspective. It's an interesting one to check out.
Some nice bedtime reading. After people have read the minister's speech and, determined what tax changes are ahead of us for the year ahead, which we'll all know about by the time we release this.
Gripping. And hopefully there'll be some changes on the exit tax piece. And I'm not that hopeful or optimistic. I'm a rational optimist, but it would be wonderful and certainly level the playing field for many investors and encourage more people to get invested when they mightn't otherwise.
Yeah, I agree. I'm with you. If I had to call it here and now today, well, we can actually make a prediction before it actually. It is 5 to 10 on the 7th of October for anybody who is interested. Yeah, my instinct is there may be some change, but I don't know if it will be material. And actually, around that whole exit tax, I read an article recently which just offered an alternative view on, the exit tax regime. It can be beneficial sometimes for people who are in an income generating phase of life and who otherwise have income that would, if it was a dividend, be taxed at up to 55%. So we tend to demonize it, but sometimes at the cost of seeing that it does have some advantages.
100%.
But in the main, it doesn't do anything other than add complexity and cost. And from our perspective for expats, it is an area where clients get a nasty, nasty shock. So let's see what they have to say. I'm with you. I think it'll probably be little, if anything, but let's hope we're wrong.
Yeah, I think you might be right, but absolutely, hopefully we'll be proven wrong.
Paddy, I really enjoyed that. Thank you so much for coming on. I to be honest, don't think we touched on lots of issues we could have delved into, which I'm sure your clients can listen to on your own podcast, but perhaps we'll have you back in future. And thanks again for your time.
My pleasure. Thank you, Steph.
Thanks for listening to Taxbytes for Expats. Please do leave a rating or review wherever you listen to your podcast. And as always, remember to take professional tax advice specific to your personal circumstances before acting or refraining from action in connection with the matters dealt with in this series. The material in this podcast is intended to give general guidance only.